So how you doing, friends? Ernie here, and this is 0 Days to Expiration. Day today. What I had said before was that I had the music queued up and it went a little smoother than it did in the previous days. However, I didn't have the promised music. I will have that tomorrow. Anyways, it is January 5th, the day after the Fed minutes, and so it's always interesting to see how the market reacts, particularly when there's a surprise narrative that comes out. And the narrative from the Fed was certainly a surprise. It was much more hawkish. I shouldn't say it was a surprise because Jerome Powell has been saying all along that he's going to be hawkish, that he's going to put the pedal to the metal no matter what. He's going to drive us all into the poorhouse as long as he can get inflation down, because that's what is important to him. Never mind the fact that the Fed's mandate is to ensure maximum employment and a stable monetary system, of which apparently they're going to disregard both of those mandates by driving the economy down, putting people out of work. As of course you've heard that, or you may have heard that a lot of large companies are now announcing huge layoffs. Amazon last night announced 18,000 people in the can. Salesforce, I think 5 or 10,000, something like that. And they're not alone. There were plenty of those announcements prior to the new year even. And although it's not reflected in the jobs numbers, shows something completely different, but there's a little catch there. There is a catch there, and it's a very important catch. First of all, the unemployment numbers came in a little bit better than they expected, but that is a lagging indicator, always has been. Yesterday, we had the JOLTS job openings that showed more job openings than they expected. That's confusing, considering that all of these companies now are announcing layoffs. So you got to wonder whether or not those job openings are real or if they are just to gauge the temperature of the market. I don't know. And I'm not going to say one way or the other. But one thing that is for certain, that household jobs, or the people that actually live in a home, that go to work, there is a report that counts whether or not they're in a job or not. They say, hey, I'm working or I'm not working. That number has been diverging from the official employment number since the beginning of the year, or since April, I guess, by not just a little bit, but by at least 2.5, maybe 3 million people. So what we're really talking about is not an unemployment rate that is at, 3.5%, 4%, but really closer to 7.5%, maybe even 8%. Now, why those numbers are diverging, why the official government numbers are showing beds of roses and everything's rainbows and unicorns, while the numbers that are being reported directly from households, people, actual people, are reporting something completely different, must be an accounting error. Apparently the accountants can't count, something like that, right? So that's an interesting thing. Now, I believe the people more than I believe the government. Oh, that felt good. Yeah, I believe the people more than I believe the government numbers. It has been apparent that the government has not only been fudging the numbers on the GDP and inflation numbers to make them look politically good, but now also jobs numbers, and who else knows what other numbers that they're fudging. But that's a sad commentary, to tell you the truth. All right, where was I? Talking about the aftermath of the Fed. So this morning, the market looked fairly strong because yesterday, after the Fed, it rose a bit. And I think that the market was still trying to digest the full impact of what Jerome Powell and company wrote in the minutes. And so even this morning in the futures market, the prices were rising. And then when this morning's reports came out and the market opened, it dropped pretty hard. But it stayed inside of a particular range. So it's not a huge drop per se. It stayed inside the range that we've been in the past, 3 or 4 weeks. Let's take a look at that. Let's go over to the charts and let me get a little bit more data in here. So we're looking at the E-mini S&P futures. And so this is showing the market back to the middle of December. And right here is where we broke down out of that big megaphone pattern. And we have been basically going up and down, but within a particular range. It looks like the bottom is where this purple line is. And you can see we've created a value node here, and we're finding comfort there. It can't get below it, can't get above it. And even with today's move, it went from the top of that range to the bottom of the range. And this was my prediction for the day. I don't know if we're going to get the green arrow, but I thought that we would come down and hit this level, which is at 38.20, and then potentially go back up to this level where we started the day. So we'll see what happens. Right now, it looks like we're heading back down. I don't know what's going to happen. I think the market is more or less digesting fully. It's now getting down beyond the gut and into the lower intestines, and they're starting to feel that rumble in the tummy, and they're wondering how they're going to deal with all that. That's where we're at right now. Where are we going to go? That's the big question. So we're consolidating here, and this is a fairly long consolidation. Usually when you have this kind of consolidation and then you start tightening up like we are here, there's a break. There's almost always a break. And will that break be up or down? I'm betting down, because that would be the continuation out of this drop out of the megaphone pattern. You're saying, what's the megaphone pattern, Ernie? Let's zoom out a little bit more. And so here's that consolidating area. And the megaphone pattern is this right here. Looks like a megaphone. See right there? So when you have an expanding, it's also called an expansion pattern. It looks like a megaphone, so we'll just call it a megaphone. You get this expansionary move, and then when you break down from that, this is particularly a bullish look. When you have a top that's like that, and we move down. Now we've come down, we've consolidated. I'd say that the next move really is probably this way. That way, just like that. This here was temporary, maybe wishful thinking on my part for today, but that's what I think we're going to go. Now, will it be today? Will it be tomorrow? Today, I think, is almost over, so let's not say today. And you can see how it's slowly consolidating here. So that's where we're at. All right, that's the context of the market. And what we'll do next is look at how we approached today's market. And let me talk a little bit about these lines that are here too, so that you understand that that is really a principal part of our trading and our analysis. And you've probably seen me talk about this and demonstrate this many times on Monday mornings. This is the volume profile market structural analysis that we're providing here. And I put this purple line in here only to prove a point, actually. This purple line and this lighter colored line right here today, as I was demonstrating that to our members. But anyways, these lines, what I call LVNs or LVLs, or low value levels, are really mapping out the structure of the market, the market memory, the inflection points, the points where you're going to find support and resistance. And you say, how is that possible, Ernie? Now, when I draw these with a much larger time frame involved, I cannot see. Now, let's go zoom in on this just so before I zoom out and demonstrate this. So when we're here on a 15-minute time frame, you can clearly see that this purple line is providing support right here. Every once in a while, you dip down below and come up above. Right here, clearly. And then there's this other LVL up here that is also providing resistance here, etc. And of course, you always have these extraneous moves that go above and below, but essentially those levels are being respected. Now, they weren't drawn based on any Fibonacci level or a trend line or moving average or anything like that. They were drawn from actual data. And when I say actual data, I'm referring to the volume profile. The volume profile is a mapping of all the volume of things that were traded at a particular price. So this isn't made up data. This is pretty much the exact same thing, only looking at it from an orthogonal view as the price chart itself. This is the amount of volume at various levels that was traded in this asset. So this is not derived, it's not calculated, it is the actual raw data. You got to really And embrace that. It's raw data. It is the data. It is nothing else. It is the thing. No calculations, no anything. It is what happened in the market, every bit as much as the candlesticks. The only difference is that the volume profile includes both volume, price, and time, where the candlesticks, which we all look at, only include time and price. They don't include volume, unless you put a volume indicator down below here. But that's only showing you the volume for a particular day or that particular period. This is showing you the volume at every single price. That is the thing that institutions and investment houses and fund managers, that's what they care about. They don't care about individual days. They care about levels, because those levels will tell them whether there's liquidity there or not, whether there's value there or not. That's why the volume profile is so important. And looking at the session volume and all these other ways that other people are looking at the volume profile, there might be some value there, I can admit, but not really. The real value is in the memory that is, I don't know how to put it, imprinted on the market over a long period of time. Now, there are scholarly works that talk about this, and what I'm getting at is how I'm coming about to get these horizontal lines and how they are so impactful, how I can draw them at a time scale where I can't see that price. Yet when I zoom in, that price is respecting it like it was there all along. All right, so let's go to the daily time frame. Now, when I go to a daily time frame and I give you more than 2 years of data, that's what we're showing, all the way from 2021 to 2023. So we're looking at the profile from all this data from here all the way to the present time. And so now the way I draw these volume profile lines is I take a look at the profile and I find the sharpest change in price that I can find, including the very low points. The high points aren't so important, believe it or not. Most people focus on those. They call them the POC, but they're not that important. I don't understand why people look at the POC. It's really not that important. It doesn't provide support and resistance like a lot of people say at all. Support and resistance are found at the edges of huge change in volume, right? So it's either on the edge of one of these nodes or at the very low point here in the volume profile. This is what defines the structure. This is what defines the lines of demarcation that institutions, investment houses, fund managers, professional traders, that is what they're paying attention to. That's it. Because for them, that is where those are the lines that separate value from not value, liquidity from no liquidity or low liquidity. That is all they care about, right? You got to think like the professional. This is what they're looking at. This is what is important to them. So what we do is we just illustrate it or mark it up and show where it is. And we do that by drawing these lines and right over where those features are. And so to prove the point, like I just did just a few seconds ago, hey, look, I can't see the individual days in here. These are day bars. I can't see a 15-minute or 5-minute bar inside here. However, when I zoom in, lo and behold, those lines I drew are providing an insight to where support and resistance are. Now, it'd be dumb for me to say they provide support and resistance. It's like saying a trend line is providing support or resistance, or a moving average is providing support or resistance, which is the stupidest thing I've ever heard. Moving averages cannot provide support or resistance. Some people say, well, I use the 9 EMA, or I use the 30, or I use the 50-20, or whatever it is. It doesn't matter. You could use the 7.25, or the 11.76, or the 99.1. They would all show apparent support and resistance because price would bounce off of them. It has nothing to do with the moving average. It's just the way things calculate out. To say that they provide support and resistance is dumb. No, it's ignorant. Maybe not dumb. Dumb, ignorant, pretty much the same thing. Moving averages do not provide support and resistance. There is one exception. You might say the 200 moving average on the day chart might have some effect only because big institutions have their buy and sell programs set on that moving average. And so that's where they may provide some level of support or resistance, but it's only because they kick off their buying or selling there. And by doing that, they're creating volume profiles. So it's a lot easier to see it just by looking at the profile. Anyways, that's what we're actually dealing with here. And that's what these purple lines and horizontal lines are. They are illustrating or marking up the market structure. That's what we use as our primary tool for finding support resistance. And there's a lot more to it too. We can also tell when volume is moving from a high liquidity area to a low liquidity area. Once it passes that barrier, that line of demarcation, what its likely behavior is going to be. What its behavior is going to be inside a volume node or outside of a volume node. When it encounters an LVL, one of these horizontal lines, how is it going to behave? Is it going to get rejected or allowed to pass through? Those are all things that we look at. And it all comes from the volume profile and analyzing it the correct way, the way that an institution or a fund manager looks at it, not the way that a retail trader looks at it. All right? I'm just trying to make that point. There's a big, big difference. All right. Hey, now that I've gotten off my soapbox, we'll try to figure out. Now, let me just be clear that the volume profile is not telling me where the market's going. The volume profile is telling me what is likely to happen when the market gets there or crosses there or pierces this or goes through that or is in that particular area. That's all it does. Because it's like me being able to tell whether or not you're walking across, I don't know, a rocky surface or a nice smooth surface, right? I can tell that when you're walking across a rocky surface, you're probably going slow and methodically. When you're on a smooth surface, you speed up. You can look at the liquidity and low liquidity and high liquidity areas like that too. Or when you encounter a door or a passageway, either it's locked or it's opened, or there's a gatekeeper there or there isn't. All right. Now, where was I? I was going to talk about our trading today. So in seeing the move down today, we'll go back to the chart. Let's zoom out a little bit. So this is the open right about here. And in seeing this move down, I was hesitant to take a trade. We like to take our signature classic butterfly, an asymmetric trade early as we can. And in some cases, put on a second one if we can. But in this case, it was falling, so I didn't do anything. Waited. And once it got down here and showed that it wasn't going to pierce through here, I had a pretty good feeling it wasn't going to, at least initially. I recommended that we put on a bullish out of the money fly, which meant that we put that fly up here somewhere, like up here. This would represent the width of it. It was approximately 30 wide. I don't know what the actual numbers are. Let's find out what the actual numbers are. They were on the XSP. That's going to be here, right here. 387, see, from 389 to 384. Okay, so 384 is right about here. And 389 is, so this is how big this spread is, right about there. Now this is the ES, so SPX is a little bit different. So it would be about 25 points different. So we're actually down about, say, to 338, and this would be down about to 388. That would be more accurate. So this is where the fly that we put on. Now, is that right? Something like that, right around there. So it started to come up into it, now it's moved away, and so it's probably, at this time of the day, there's only half an hour left. Will it come back up into profitability? I don't know. That's why we chose that, because I felt there was support here and that it would move up. Originally, I had this going down to about here and then thinking that we would move up. But that never happened. So the other thing I recommended is, because of it's after the Fed day and the market is in such turmoil, that we just take it easy and make sure that our exposure to the market is relatively small. And so that's why I traded the XSP, or that's what I'm trying to illustrate by trading small. And so that was a good call. Trade small, put it far enough out of the money, and look for a good risk to reward. We generally look for a 1 to 9 risk to reward. And you'd probably know that if you're following the course, which I'm going to do in just a few minutes here. And so what we'll do now is we will do a roll call and see see who's online here, see how we're doing, and then we'll get to the second part of the course. The course itself, it's an online free course that I'm talking about how to trade the out-of-the-money butterfly on 0DTE, and I'm presenting it live on the second half of my Final Hour show each day. And then what we're going to do is package that up and then put it in a course that will be publicly available on the website. So you'll be able to watch it anytime you want. You'll see how to trade the fundamental unit, the fundamental trade that we base all of our other trades off of. All right. So that's how this works. All right. Let's go to the roll call and see who's online here. Hey, we have Rick Winnard. How you doing, Rick? Oh, by the way, if you like the content so far, give it a thumbs up. And if you're not a subscriber and you want to be notified when we have new content coming out, subscribe now. And Amo Jones, how you doing? Nice to see you. MB, I'm not familiar with that name. Maybe a new user, maybe a new member. And Jay Hens here, how you doing? And Philip from Belgium. Nice. And is here with double barrel. Philip wants to know, is the max pain option zone? Is the max pain option zone? I think you may be asking whether or not max pain is a factor in what we do. And in the beginning, we looked at max pain, and there's a lot of controversy around whether or not price is attracted to max pain. And you have to admit that every once in a while it is, but it's not something that you can reliably count on as a day-to-day thing that you're going to trade your strategy around. So the answer is no. We don't even look at it anymore. AP Sweet says, I guess we have to call Nancy Pelosi back. Politics. Frank Lattel's here. Good day. Good day, mate. And 123 Happy Street. We are go. Flight. I'm not sure what he means by that. Tim Dodds, how you doing? Yes, it is the afternoon. So Philip's saying in regard of premium. Yeah, no, still op interest, premium, pain. No, just don't look at it anymore. We looked at unusual volume. We looked at max pain. None of that was consistent. The answer is that we simply don't look at it. And we've done extensive study. It does not produce any consistent results for us. So we don't. We employ the methodology that we have here. And we have a few strategies that we're developing that take advantage of various market contextual situations. But our fundamental strategy is all built around that asymmetric returns around the out-of-the-money butterfly and putting it far enough out with that 1 to 9 risk to reward. Now, all of that 1 to 9 and certain widths and all of that comes from extensive study that we've done on what works in this market. Those are kind of fundamentals that we use, and then we build our trades around that. So we have a new trade that we call the Batman, and the Batman we found has been very instrumental in this bearish market, particularly when we have bear market rallies and you have all that whipsaw and can't very easily choose a direction one way or another for whatever reason. You don't have a backstop. So we'll put on the Batman, which is more of a market neutral, but still created from those two fundamental trades on either side of the market. And then we have our management strategy built around that. In fact, that's what I'll be talking about in the course today, is how we do profit management. Yesterday, I talked a little bit about the fundamentals around a butterfly, how it's constructed, what we're looking for, and what was the basic setup that we use. And so today, I'll be talking about the basic profit management strategy that we use and how we go about it. And then later, tomorrow, we'll get a little bit more in depth. We'll talk about the market structure using volume profile. And then later on, we'll start looking at real trades, real examples, and applying that. So it's going to be a great course. Oh, an Apollo 13 reference, Ed Harris was flight. Yeah. Lots of these references go right over my head. But what won't go right over my head is, I don't know. You see this guy right back there? I want to show you something. All right. See, that's Bitcoin Bob back there. He wears this Bitcoin hat. And every day, Bob gets his hat knocked off. All right. Let's get back to work here. We're going to come back and start up the course. And we'll do a little interlude here first. And I'll put on the little interlude thingy. See you in a bit. And it's all because of Theta Thief. So I'm going to get that down sooner or later. I was muted there. Anyways, this hat. See, it says Dead Sea. My son just got back from Israel. He was there on his birthright. If you are the direct descendant, or your mother is a Jew or your father, both, you get a free all-expense-paid trip to Israel for 10 days up until the age of 26. He's turning 27 in next month, so he wanted to get that benefit. And so anyways, he just came back this morning. I picked him up at the airport, and he gave me this hat. So there you go. Can't wait to go out into the wilds and wear it. Now, back to this hat. I know, audio is hard. So I've got this really amazing setup here, and I've got a soundboard, and I've got video switchers, and I've got lights and cameras, the whole deal, and these wonderful microphones. But I'm like a one-man show, and sometimes I just push the wrong button. So anyways, this is the second half of the show where we're going to go on with the course on our primary strategy, what we call the classic butterfly, the classic 0-DTE butterfly. And it's, like I said, the basis for most of our trading. So what we're going to do is go off to the charts, check that out, and just give me a second here. All right. Okay, sorry about that. Now we're picking up where we left off yesterday, where we're talking about the 0-DTE butterfly entry rules. And it's pretty simple. We don't do any kind of delta or probability of profit or anything like that. It's really all based around risk to reward. And so what we're doing is looking for a 1-to-9 risk to reward. And generally we're putting on as wide of a fly as you can afford. Now, it's pretty easy to figure out what the debit and max profit of that's going to be. The way we do it is we just simply try to put on something, let's say it's 30 wide. And so that's a $3,000 spread minus the debit. We like to get the debit at 1/10 the size. That would give us the 1-to-9 risk to reward. So on a 30 wide spread, we're looking for a debit of $3. And that would give you a max profit of about $2,700. So if we're putting down $300 for the potential of making $2,700. And if it were a 20 wide, then we would be looking for a price of $2. And that would give us, again, that 1-to-9 risk to reward. And so that's how we put down our trades. Now, it's a little bit more complex than that, but that's generally what we do. And that's proven to be a great formula. With the profit management strategy that I'm going to go over, and your diligence and discipline on this and doing this over and over again and getting better at it, you should be able to do somewhere between 3 and 7%. I would even say 4 to 7% per month. And that's trading super small. So if you had let's say a prototypical account, say $25,000, and you only traded one position like this, then over time, you should be able to achieve something like that 3 to 7% per month return, which is darn good. Now, all right, so what we need to do now is go on to the next page so we can talk about actual. Now, here's the interesting thing about trading on 0-DTE. Trading options, and particularly when you're trading right into expiration, is all about that time. Well, it's a 3D composition. And what I mean by that is that it's time, delta, and volatility. So time is a really important component. And when we're trading the butterfly, there are only so many positions that price can be relative to the fly and how we would then treat the trade. But more importantly, how you do that, depending on what position it is what time of the day is it? Is it the morning, which is what we term as 9:30 to noon? Or is it the early afternoon from 12 to 2:30? Or is it the late afternoon, 2:30 to 4? And the reason why we do that is because the way volatility or the way the premium is growing at those different times of the day is different. And also the gamma risk is continually increasing as you get closer and closer to the end of the day, etc. So we break up the day in this way and then develop our exit strategy based on one of those 3 time zones. And then we further break it down to where is price? Is price going to be outside of the profit tent and maybe in a loss? And in most of those cases, whether it's early or in the morning or early afternoon, we simply let it go. Very rarely do we try to chase it because we always feel that there is a chance that it could come back and profit for us. But more cases than not, believe it or not, we're allowing our loss, that defined risk, to be accepted. Now, occasionally, if you have two of these on, then you might manage it a little bit differently. You might make sure that you recover at least some profit from one while you're at least some value from one while you're profiting from another. But for the single fly, generally it's just, hey, let it go. If you're near the long leg, and depending on whether you're in the morning or the early afternoon or late afternoon, you're going to have a different set of criteria. That criteria is going to become more aggressive as you get to the later afternoon. And if you're inside the profit tent, then we have various techniques for trying to essentially use a kind of a trailing stop or a mental trailing stop to try to capture the most profit possible. And so we do that. Now, the reason why I put this up here like that is that's what we use as a template every day when we're journaling our trades. So that's a fundamental thing. That's a fundamental component to coming up with your strategy. Now, I don't have a prescriptive strategy that I'm going to give you. What you need to do is find this out on your own. I can give you guidelines on how to determine what your best move is going to be. But over time, you're going to find your own nuances to this trade that are going to make this trade all your own. And that's something that I'm going to cover later on in terms of how do you go about journaling? How do you track these trades? How do you analyze them? How do you categorize them and then put them into a playbook that you can use and build up over time so that you can develop a true trading playbook and your own that you own? And like I've said before, our primary goal here at 0-DE, zero DTE, is to help every trader that comes through our service to become an independent professional trader. And so this is part of that exercise. This framework is what you would use to be able to determine what your strategy is going to be in the various segments of the day and depending on the positional characteristics of or relative to the butterfly. So there you go. And now I'm going to go on to a study that I did I think that you'll find very interesting. And this has to do with how we come up with the type of trades that we take. Now, I said that you take a 1 to 9 risk to reward 30 wide, but why do I say that? That's all based on the nature of premium decay at various points in the day and how it's different across different width flies. Okay, sorry, just closing a trade here. Cool. Just make sure it's closed. All right, there we go. All right, so this study, what I've done here is that I've taken a trade that, in this case, it was a 1 to 7 risk to reward, but that's immaterial. What I'm doing is I'm testing the value at the short strikes of premium at half-hour increments throughout the day, and then looking at with butterflies during that time. And that's what you're seeing across the top here from 10 to 35. The green area is like the sweet spot time that we would take any one of these trades or maybe take profit from any one of these trades. Yep, it just closed it. There you go. And one thing that you'll notice here is that the 10 wide fly doesn't even start accumulating any kind of appreciable premium decay until the afternoon time. The 15 wide, not until really the late morning. It's not until you start getting to the 20 or the 25 that you start, if you put a fly on early, that you're going to start getting any appreciable decay in premium. And what that really means is that profit curve is rising into and allowing you to garner enough profit so that you can exit with a profit. And then when you start looking at 30 and 35 wide, it's amazing how much faster and sooner that they start developing that decay of premium. And this down here, down below, you'll see 70%, 213, 223, up to 356%. That is the amount of return relative to the risk for each one of these trades. And you can see that it explodes at 30 and 35 wide flies. Over to the right here, that this is a graphical representation of premium at each individual time level. And you'll see that not only do the wider flies produce a lot more premium, but the rate at which that premium grows throughout the day accelerates as you go wider. And that's really important because that will tell us when's the optimum time to put on a certain width fly and what we can expect from it during the various time periods. And so this is something that we study, and this is one of the reasons why I've determined that the 30 wide is really like the ultimate. If I can't put on or I can't afford a 30 wide from the SPX, then I'll just put one on with the XSP or put one on with the E-mini S&P futures, which is about half the size of the SPX, and then the XSP is about 1/10 the size of the SPX. So I have a lot of choices that I can use to figure out at what level of granularity I want to put a trade on. Of course, with the E-mini, you deal a little bit more with the cost of the trade, but when we're talking about the potential profits that we have here versus the cost isn't as much of a factor, particularly when you compare the way we trade to the way other 0DTE outfits trade with the Iron Condor, where the profit that they're going after, or the premium, is an order of magnitude less than what we have. So what they trade is extremely important. If they trade the E-mini S&P, it's tougher for them because the cost is taking up most of the premium that they're going to collect. In our case, it's actually just, in many cases, just a small fraction of the premium that we're collecting. Another reason why trading this way over the high probability way is superior in every way. It's just superior in every way. All right, so that's pretty much the lesson for today. Tomorrow, I'm going to go over in more detail the strategy for taking profit. But now you know why we choose as wide a fly as that we can and as early as we can, because that gives us the greatest opportunity. And so tomorrow we'll go over fixed strategies. We'll look at the cases and we'll walk through those trades and how we develop our overall journal and playbook so that we can then grow as a trader. So we do this every week. We build up our playbook every week. After a course of dozens of trades over months, our playbook starts becoming something real and categorized into different contextual things, keeping track of not only the quality of the positions that we went in, but also our mental acuity and how we felt about that trade. And so what we're really looking for, let me bring on the big head. So what we're looking to do is create a continuous improvement process by doing this logging and keeping close track of everything that we do, and then evaluating it periodically every week, and then looking at our process. Now, everything about this is about developing that process. You shouldn't be focused on your outcome of each individual trade. If you perfect that process, and there's no perfect process, but in your journey as a trader, you're focused on creating and perfecting that process to your best ability. And it really becomes just a linear series of habits that you develop. If one of those habits starts going awry, then you figure out what the problem is, and then you correct it. And that's what you're doing. You're continually correcting that process, getting better and better, getting a better understanding of all the different trades, situations that you're in, the context of the market, your mental makeup, everything. And even the process that you start the day with, is that contributing to your consistency? So that's what this service is all about, is helping you get to that point. That's what a professional does. That's what we teach. All right, that's about it. I want to thank you very much for joining me. Let's see. All right, just reading some of the comments there. So I want to thank everybody for showing up. We'll be here again tomorrow. Like I said, every show is 2 parts. We do a market analysis, what type of trades that we were in, how we did, and then how we finished up the day. Thank you very much. Peace to you all. We'll see you tomorrow.